In the unfolding drama of American politics and finance, cryptocurrency has emerged as a contentious and pivotal player. With its rapid ascendance, understanding the nuances of this digital currency has become essential not just for tech enthusiasts but for every American. As the nation grapples with the implications of cryptocurrency integration in existing financial systems, the stakes have never been higher. The recent resurgence of interest in cryptocurrency has been significantly propelled by former President Donald Trump, who has entered the crypto scene with a strategy that experts are increasingly scrutinizing. Despite his late arrival to the digital currency party, Trump has recognized the potential for personal profit, aligning himself closely with cryptocurrency advocates who have gained influential positions in his new administration. This alignment raises profound questions about regulatory oversight and the economic environment at large. Financial experts are voicing concerns that the administration's embrace of cryptocurrency could expose the economy to heightened risks, particularly as the crypto market has already witnessed a staggering loss of approximately $659 billion from its peak. This volatility is alarming for investors and could foreshadow a broader economic fallout. As the crypto landscape evolves, so too do the challenges it presents. Cybersecurity remains a formidable barrier to widespread adoption, with a recent Pew Center survey revealing that 63% of respondents consider cryptocurrencies unsafe. This skepticism is reflected in the stagnation of transactional use, with only 17% of adults reporting they have engaged with crypto for transactions, a figure unchanged since 2021. Coupled with the volatility and political tensions surrounding digital currencies, these security concerns are critical factors that regulators and companies must address. As states like Arizona move to implement regulations aimed at curbing crypto-related scams, there is a clear recognition of the need for protective measures. Arizona lawmakers are targeting the burgeoning market of crypto kiosks, seeking to create a framework that safeguards consumers against fraudulent activities. This regulatory push reflects a broader trend of governments grappling with how to manage the rapidly evolving cryptocurrency ecosystem, aiming to strike a balance between innovation and consumer protection. Simultaneously, experts argue that the crypto sector is increasingly resembling a high-stakes casino, enticing investors with the allure of quick returns while exposing them to significant risks. The rise of meme coins and speculative investments underscores the need for education among both investors and industry professionals. The tech podcast What Next? TBD recently launched its own meme coin, highlighting the intricate and often opaque process of creating a digital currency. This endeavor serves as a cautionary tale about the complexities and pitfalls of the crypto realm, emphasizing that the odds are often stacked against the average investor. In light of these developments, a comprehensive overhaul of cryptocurrency regulation appears imminent. The introduction of bills like the Stable Act aims to enforce stricter compliance measures and real-time communication protocols, providing a semblance of order in an otherwise chaotic landscape. However, the onus is also on individual firms to proactively adapt to the changing environment, ensuring that they implement robust cybersecurity practices and educate their teams about the distinctive nature of crypto transactions. As we navigate this uncharted territory, the future of cryptocurrency in America remains uncertain. Will it solidify its place as a legitimate financial instrument? Or will it succumb to the chaos and volatility that have characterized its past? One thing is clear: the intersection of cryptocurrency and American politics is a narrative that is still unfolding, with implications that will resonate for years to come. As we look ahead, the call for informed engagement and regulatory diligence will be paramount in shaping the future of finance in this digital age. As the cryptocurrency landscape continues to evolve, Bitcoin's role as a potential safe haven asset is being scrutinized amid shifting economic conditions. Recent developments, particularly in the United States, hint at a possible resurgence in Bitcoin's appeal, especially as institutional acceptance grows and inflation fears resurface. Bitcoin's market dynamics are not only influenced by its inherent qualities but also significantly shaped by external economic factors and regulatory movements. The current conversation surrounding Bitcoin is largely anchored in the context of the U.S. economy, where expectations of a potential recession loom large. A survey conducted by CNBC found that 75% of CFOs anticipate a recession beginning by the end of this year or early next. Amid these concerns, Bitcoin has been perceived as a hedge against inflation, driving interest from investors looking for refuge in digital assets. As President Trump announces plans for a strategic crypto reserve which includes Bitcoin as a primary holding, the narrative around cryptocurrency as a legitimate financial tool is gaining traction. In addition to macroeconomic indicators, the introduction of spot Bitcoin exchange-traded funds ETFs has been transformative. The iShares Bitcoin ETF Trust, which debuted last year, has amassed nearly $50 billion in assets, illustrating the growing mainstream acceptance of Bitcoin. Such financial products provide investors with easier access to Bitcoin, allowing them to invest without navigating the complexities of cryptocurrency exchanges. This ease of access could potentially lead to increased demand and a rise in Bitcoin's value, especially as the ETF market matures. However, the outlook for Bitcoin is not without challenges. The cryptocurrency has experienced significant volatility, with its price dropping approximately 12% over the past 3 months, reflecting investor anxiety amid economic uncertainty. The correlation between Bitcoin and the stock market is also evolving. Research from Standard Chartered indicates that Bitcoin's correlation with tech stocks has increased significantly, suggesting that Bitcoin may no longer be the uncorrelated asset it once was. This shift raises questions about its role as a digital gold in an increasingly interconnected market. Bitcoin's current price, hovering around $83,900, contrasts sharply with gold, which recently hit a record high of over $3,000 per ounce. While Bitcoin's price performance has been tumultuous, it has historically demonstrated substantial long-term gains. Over the past 5 years, Bitcoin has soared over 1,100%, presenting a compelling case for its speculative nature as an investment. Nonetheless, the unpredictable nature of cryptocurrencies means that potential investors should approach with caution, ideally limiting their exposure to a small percentage of their total portfolio. Looking ahead, the trajectory of Bitcoin will depend significantly on macroeconomic developments, regulatory stances from the U.S. government, and the broader acceptance of cryptocurrencies by institutional investors. As the landscape evolves, Bitcoin could either solidify its status as a mainstream asset or face challenges that might hinder its growth. The coming months will be critical in determining whether Bitcoin can reclaim its position as a hedge against inflation and economic volatility, or if it will continue to align more closely with the performance of tech stocks. In conclusion, while there are signs of renewed interest in Bitcoin amid a backdrop of economic uncertainty, the road ahead remains fraught with challenges. Investors will need to remain vigilant, weighing the potential for significant gains against the risks inherent in this highly volatile market. As regulatory frameworks develop and institutional interest grows, Bitcoin's future could very well reshape the contours of the financial landscape, but the outcome remains uncertain. In an era where cryptocurrency has cemented its presence in the political and financial landscape of the United States, the intersection of digital assets and governance is becoming increasingly complex. With former President Donald Trump's return to power, the crypto market has found itself at the forefront of American politics, dictating not just investment trends but also electoral dynamics. As the implications of this relationship unfold, it is imperative for investors and citizens alike to understand the evolving nature of cryptocurrency and its impact on both personal finance and broader economic policies. The integration of cryptocurrency into mainstream finance is not merely a passing trend. It has become a formidable force influencing American politics. According to a report from the progressive think tank Public Citizen, crypto interests accounted for nearly half of the corporate money spent in the 2024 federal elections, second only to fossil fuels. This staggering figure underscores the financial muscle behind crypto advocacy. As industry players leverage their resources to shape policy and public perception, It's like the corporate money Death Star, remarked one of the researchers involved in the report, highlighting the overwhelming influence of crypto backers. Despite this political clout, the reality of cryptocurrency ownership among Americans tells a different story. Less than 1 in 5 citizens has ever owned crypto, and the dream of it becoming a widely accepted payment medium remains largely unrealized. The disconnection between the crypto industry's cultural prominence and its actual usage raises questions about the sustainability of its influence. As Alex Kirshner noted in Slate, while crypto has become culturally inescapable, its practicality as a currency is still a fantasy for most consumers. This paradox is further complicated by the emergence of cryptocurrencies as speculative investment vehicles. Bitcoin, for instance, recently surpassed the $100,000 mark. Yet its value is largely driven by market sentiment rather than any underlying asset. This speculative nature can lead to significant volatility, as evidenced by the recent sharp declines in the prices of major cryptocurrencies like Bitcoin and XRP. Such fluctuations pose risks not only to individual investors but also to broader financial systems, especially as companies like MicroStrategy and Coinbase invest heavily in crypto, intertwining their fortunes with these volatile assets. The political implications of cryptocurrency are also becoming evident through the actions of Trump and his family. Recently, they launched their own crypto tokens, which have sparked both excitement and skepticism within the crypto community. While some view it as a clever fundraising strategy, others decry it as a betrayal of the decentralized ethos that initially attracted many to crypto. The reality is that these tokens serve as a means for the Trump family to capitalize on their political influence, raising significant funds while potentially exposing less sophisticated investors to financial risks. Adding to the complexity, investment firms linked to the Trump family such as Dominari Holdings are adopting strategies that incorporate cryptocurrency into their portfolios. Recently, Dominari announced it would invest $2 million in BlackRock's iShares Bitcoin Trust, moving away from direct Bitcoin purchases to a regulated ETF that simplifies compliance and accounting. This pivot reflects a growing trend among corporate entities seeking to navigate the regulatory landscape while still gaining exposure to the lucrative crypto market. As the influence of Trump and his administration continues to shape the crypto landscape, investors are keenly watching for further developments. The endorsement of meme coins. Particularly the Trump token has reignited interest in speculative investments within the crypto space. With the upcoming token unlock on April 18, market participants are bracing for potential volatility as insiders and retail investors alike consider their next moves. Looking ahead, the trajectory of cryptocurrency in America is uncertain but undeniably significant. The fusion of political power and digital assets presents both opportunities and risks, making it essential for investors to stay informed and vigilant. As the crypto market continues to evolve, understanding the implications of regulatory changes and market dynamics will be crucial for anyone looking to navigate this increasingly complex environment. The intersection of crypto and governance is set to reshape not only investment landscapes but also the very fabric of American financial policy in the years to come. On March 28, 2025, the cryptocurrency market experienced significant turbulence, particularly impacting Ethereum ETH, which saw its price plummet by over 11% to around $1,880. This sharp decline has raised concerns among investors and analysts who are now closely monitoring key support levels and the broader implications for the crypto landscape. The sudden drop in Ethereum's price was precipitated by a broader downturn in the cryptocurrency market, largely influenced by Bitcoin's recent struggles. Bitcoin, which had been hovering around the $87,000 mark, fell below $86,000 just before Ethereum's nosedive, triggering a wave of liquidations of leveraged positions. Such forced liquidations often lead to rapid price drops, but this time the anticipated rebound failed to materialize. The overall market capitalization of cryptocurrencies decreased from approximately $2.79 trillion to about $2.71 trillion, reflecting a widespread decline in confidence. Analysts are now grappling with the reasons behind this downturn. There are indications that external economic factors, including a rising dollar index and increasing gold prices, are contributing to a risk-off sentiment among investors. Gold recently reached an all-time high of over $3,080 per ounce, while the dollar index has shown signs of stabilization after a declining phase. This dynamic suggests a shift in investor behavior that could further depress crypto prices if it continues. In addition to these market pressures, more than $14 billion in Bitcoin and Ethereum options are set to expire today, which typically influences price movements as market makers aim to maximize profits around the max pain points. For Bitcoin, this point is around $85,000, while for Ethereum it hovers near $2,400. With Ethereum trading significantly below this level, the expiration could exacerbate selling pressure in an already fragile market. Adding to the complexity of the situation is Coinbase's growing dominance in Ethereum staking. As of early March 2025, Coinbase controlled 3.84 million ETH, representing about 11.42% of all staked Ether. This concentration of staking raises concerns about network centralization, a point emphasized by industry executives who warned that it could undermine Ethereum's decentralization ethos. Karen Surdesai, CEO of Mira Network, described this as a systemic issue that could jeopardize the security and resilience of the network, particularly if institutional adoption continues to escalate. The implications of Coinbase's control are significant, especially with the potential for U.S. exchange-traded funds to begin staking, which could further consolidate Ethereum's network under a few large players. Temujin Lui, CEO of OneChain, cautioned that this could lead to increased censorship risks and reduced network resilience as large entities prioritize regulatory compliance over decentralization. Looking ahead, analysts remain cautious about Ethereum's short-term prospects. Predictions are mixed, with some experts suggesting that if Bitcoin can stabilize and recover, it could lift Ethereum along with it. However, the current landscape suggests a challenging environment for crypto assets, particularly as the market navigates through this volatile period characterized by forced liquidations, regulatory uncertainties, and macroeconomic pressures. In conclusion, as Ethereum grapples with significant price declines and the broader implications of market dynamics, stakeholders are left to ponder the future of the network in an increasingly centralized staking landscape. The coming weeks will be crucial for both Ethereum and the cryptocurrency market at large as investors seek clarity amidst the ongoing volatility and strive to understand the long-term viability of decentralized systems in the face of institutional pressures. In a dramatic turn of events, the cryptocurrency landscape is witnessing notable shifts following the inauguration of former President Donald Trump on January 20, 2025. While many anticipated a surge in the popularity of various blockchain technologies, particularly Solana, the reality has been quite the opposite. Solana's market cap has plummeted from a robust $130 billion to a mere $70 billion, reflecting a staggering drop in trading volume and user engagement. Despite Trump's endorsement of Solana through the launch of his memecoin, the blockchain has not only experienced a decline in value but has also been caught in the broader bear market that has seen Bitcoin drop by 20%. The trading volume for Solana's native token has collapsed from $24 billion to just $3 billion, a striking indicator of waning interest in this once thriving ecosystem. Transaction fees and protocol revenue for Solana have mirrored this downturn, with fees falling by an astonishing 93% from $90 million during the inauguration week to less than $6 million currently. Moreover, revenue for Solana validators has diminished even more sharply, plummeting 98% from $45 million to under $900,000. The number of monthly active users has also decreased significantly, down to 65 million from 98 million at the time of Trump's swearing in. The decline can be tied to a broader disillusionment with memecoins, including Trump, which has seen its price tumble by 85% within 2 months. The total value locked across Solana's decentralized finance DeFi platforms has also dropped from $11 billion to $7 billion, indicating a stark reduction in user trust and investment in the platform. As interest wanes, fewer than 0.002% of Solana-based memecoins manage to maintain market capitalizations above $1 million, highlighting the fragility of this segment. Interestingly, while Solana has struggled, institutional interest in the cryptocurrency space remains relatively strong. Major firms like Fidelity and BlackRock are increasing their involvement in the Solana ecosystem, with Fidelity filing for a Solana ETF and BlackRock launching a $1.7 billion tokenized treasury fund on the network. Despite these positive developments, Solana's price has remained stagnant, suggesting that much of this bullish sentiment may already be priced in. Looking ahead, Solana's recovery may hinge less on speculative trading and more on real-world utility. The upcoming Firedancer upgrade and the pre-order of over 140,000 Solana phones could signal a shift towards practical applications that drive user engagement. As the market braces for potential recovery, institutional investors are reportedly optimistic about new regulatory frameworks that could further legitimize digital assets, with 57% of institutional investors surveyed expressing excitement about increased regulatory clarity. Meanwhile, XRP is also navigating a crucial period, especially after the SEC dropped its long-standing lawsuit against Ripple, which issued XRP. Following this legal victory, XRP has gained traction, with analysts predicting a surge in institutional demand for the coin as the regulatory barriers continue to dissolve. The anticipation surrounding exchange-traded funds ETFs for XRP has been building. And with 86% of bettors placing confidence in an upcoming approval, XRP's price trajectory could see significant upward movement. In conclusion, while Solana grapples with a sharp decline in metrics and user engagement, the broader picture reveals a landscape ripe for potential recovery, fueled by institutional interest and regulatory advancements. As 2025 progresses, the interplay between market sentiment, regulatory clarity, and technological upgrades will be pivotal in shaping the future of Solana, XRP, and the cryptocurrency market as a whole. Investors and enthusiasts alike will be watching closely to see if these developments translate into a resurgence for these once promising digital assets.